Have you ever wondered what would have happened if you invested in Rivian stock at the end of 2021? Fast forward to March 2024, that $1,000 investment would have dwindled down to a mere $104. That's a jaw-dropping 90% decrease in value over this period. To understand why this happened, we will delve into the financial analysis of Rivian, a leading US electric vehicle manufacturer. So buckle up as we embark on this enlightening journey. Let's start by looking at Rivian's revenue from 2021 to 2024. Rivian has experienced a notable increase in its revenue, reflecting a compound annual growth rate, or CAGR, of 85% from 2021 to 2023. The company's revenue for the year 2023 stood at a whopping $4.3 billion. This considerable leap is a testament to Rivian's growing influence and success in the electric vehicle market. But the story doesn't end there. Let's take a closer look at the year-on-year sales growth. From 2021 to 2022, Rivian saw an astounding increase in sales. We're talking about a 2,918% growth, folks. Yes, you heard that right, nearly 3,000%. This phenomenal growth can be attributed to Rivian's successful market penetration and the increasing global demand for electric vehicles. Building on this momentum, Rivian continued its upward trajectory into the following year. The sales growth from 2022 to 2023 was a robust 161%. This consistent growth illustrates Rivian's ability to maintain its market share and expand its customer base, despite the fiercely competitive landscape of the electric vehicle industry. So what does this all mean? Well, it's clear that Rivian has been on a roller coaster ride of growth. The company's revenue has been on a steady incline, and its sales growth has been nothing short of remarkable. This upward trend in revenue and sales is indicative of Rivian's solid business strategy and its ability to adapt and thrive in a rapidly evolving market. But, as always, it's essential to remember that revenue growth is just one piece of the puzzle in evaluating a company's financial health. While Rivian's revenue growth is undoubtedly impressive, it's also critical to examine other financial indicators, such as profit margins, to gain a comprehensive understanding of the company's overall performance. Impressive growth, isn't it? But let's examine the profit margins next. Rivian's profit margins tell a different story. In 2023, the company's gross profit margin was negative 49%. This might seem alarming, but when we compare it to the negative 188% margin from 2022, we see a significant improvement. Now let's consider the costs. Research and development, along with selling, general and administrative expenses, are two major costs that have a substantial impact on the net profit margin. These costs combined were 56 times the revenue in 2021. However, by 2023, this ratio had decreased, and these costs only amounted to 85% of the revenue. So what does this mean for the net profit margin? Well, in 2023, Rivian's net profit margin was negative 125%. Yes, that's right, negative. And yet, it was an improvement from the negative 407% in 2022, and a significant leap from the negative 8,527% in 2021. The main reason for this less than positive profit margin in 2021 was the low revenue of $55 million combined with increasing costs. So, while Rivian has been growing its revenue impressively, the high costs have been eating into the profit margins. But there's more to the story. Rivian's net profit in 2023 was negative $5.4 billion, an improvement from the negative $6.8 billion in 2022, but still a significant loss. For 3 consecutive years, Rivian has reported net losses with no signs of stopping. So, what's the takeaway here? Despite impressive revenue growth, Rivian's high costs have resulted in a negative profit margin. The company has been improving its margins year over year, but it's clear that it still has a long way to go before it can turn a profit. And that's something potential investors need to consider. Let's take a closer look at Rivian's assets, liabilities, and key financial ratios. When we examine the figures, we find that Rivian's total assets have seen a respectable increase. In 2022, the company reported total assets of $16.8 billion. Just a year later, in 2023, this figure rose to $17.9 billion. A similar trend can be observed with Rivian's net assets. In 2022, the company reported net assets worth $9.1 billion. By 2023, this figure increased to $13.8 billion. This represents a significant growth in the company's net assets in just a year. Now let's turn our attention to Rivian's equity to total assets ratio. This ratio gives us an idea of how much of the company's assets are financed by equity. In 2022, this ratio was 54%. However, by 2023, it improved to 77%, indicating a greater reliance on equity for asset financing. Let's now shift our focus to Rivian's liquidity ratios, specifically the current ratio and the quick ratio. The current ratio, which measures a company's ability to cover its short-term liabilities with its short-term assets, was 4.92 in 2022. In 2023, this ratio improved to 5.46, indicating better short-term financial health. Similarly, Rivian's quick ratio, which measures a company's ability to meet its short-term obligations with its most liquid assets, also improved. In 2022, it stood at 3.88, but it rose to 4.92 in 2023. These figures suggest that Rivian is in a financially healthy position, at least in the short term. However, like any good story, there's more than meets the eye when it comes to understanding the financial health of a company. Rivian's financial ratios suggest a financially healthy company, but there's more to the story. Cash flow and DuPont analysis provide more insight into Rivian's financial performance. Operating cash flow and free cash flow are two key metrics that help to paint a clear picture of a company's financial health. In the case of Rivian, the operating cash flow for the year 2023 was a negative $4.9 billion. This shows a significant increase in cash outflow compared to the year 2021, when the operating cash flow was a negative $2.6 billion. Similarly, the free cash flow, which is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets, also paints a concerning picture. In 2023, Rivian's free cash flow was a negative $5.9 billion, showing a substantial increase in cash outflow compared to the negative $4.4 billion in 2021. Next, let's examine the return on equity, ROE, through a DuPont analysis. ROE is a measure of financial performance calculated by dividing net income by shareholders' equity. For 2023, Rivian had a negative ROE of 39%, showing a significant loss on equity. However, this was an improvement from 2022, when the ROE was a negative 74%. The DuPont analysis breaks down the ROE into three components: net profit margin, asset turnover, and equity multiplier. In 2023, Rivian's net profit margin was a negative 125%, its asset turnover was 0.24, and its equity multiplier was 1.3. These figures indicate that while the company was able to use its assets and equity more effectively than in 2022, it still made a significant loss on each dollar of revenue. Despite improvements in some areas, Rivian's financial performance hasn't matched up to investor expectations. The negative cash flows and the negative ROE, despite the improvement from the previous year, underline the financial challenges Rivian is facing. The key question now is whether the company can turn these figures around in the coming years. So what's the takeaway from our financial analysis of Rivian? In the past few years, Rivian has demonstrated impressive revenue growth with an annual compound growth rate of 85%. However, their profitability has been a challenge, with negative profit margins persisting over the years despite gradual improvements. Their costs, particularly in research and development and sales, general and administrative expenses, have been a significant drag on their net profit margin, although there has been a reduction in these costs as a percentage of revenue over time. Rivian's financial health is sound, with total assets growing and strong liquidity ratios. However, their operating cash flow has been negative, and their DuPont analysis shows a negative return on equity, indicating that they are not generating a profit from their equity investments. When Rivian was listed on NASDAQ at the end of 2021, expectations were high. At one point, the company's market capitalization exceeded that of established automakers like Ford and GM. This was fueled by Amazon's investment in Rivian, and a commitment to purchase hundreds of thousands of vehicles, raising expectations even further. However, investment should be based on business results, not just expectations. Rivian's financial performance has not yet justified its high valuation at the time of its listing. Before you invest, remember to look beyond the hype. Don't forget to subscribe for more company analyses and let us know in the comments which company you'd like us to analyze next.